Thank you very much, Andrew. A few of those themes we're going to come through and talk about as we move on to our investor session, particularly I think the move of funds from Asia Pacific. I thought the comment about 60% of the world's population coming from that region is staggering and something which undoubtedly we will talk about. Also some real positives, I think, for the UK economy, and once we get through the EU referendum, then I'm sure we will move ahead on that front. I'd now like to welcome the panelists for our capital flow session so we can talk a bit about who's investing in the sector in the UK. Firstly, we're lucky to have representatives from two of the most active private equity investors in the UK currently. We had hoped to have a third, but he's obviously off doing a deal. So can I welcome, first of all, Cody Bradshaw, who's SVP Acquisitions at Starwood Capital, and then Coley Brennan. Coley is Principal at KSL Capital Partners. Our panel's then made up with Simon Scott from Seiko, who behind the Beyonder brand as well. I'm sure he'll explain to you about that. And Mike Saul, who's Head of Hospitality and Leisure at Barclays Bank. I'm very conscious that we've only got 40 minutes this morning for this session. And given we've overrun a little bit before, I think Ufi will be keen that we move on. So I'm not going to give you a chance to introduce yourselves. I'll try and take some questions from the floor as we go forward. But given our focus today is on investment in the UK and capital flows into the UK, we've heard a lot, Andrew was saying, and others about the emerging sources of capital. I just wanted to start by asking our panel where they see their funds coming from, and starting perhaps with Cody. Starwood Capital, you raise your capital on a global basis. Where are you seeing the greatest inflows into your funds at the moment?
Our funds have gotten, and this is a consistent trend across the private equity real estate industry, is they've gotten significantly bigger with each new capital raise. And so where we were raising funds 5 years ago, maybe $1 billion, 2 years ago we raised our largest fund ever, $4.2 billion, and deployed that within about 18 months and raised a $5.5 billion fund. And then recently Blackstone raised a $16 billion fund. So the numbers are staggering, and the investor base is truly global, and even ranging from high net worth sort of family businesses all the way up to mega sovereign wealth funds who invest $500 million, $1 billion into these funds. And clearly it's a reflection of the low interest rate environment that's driven a lot of capital into these real estate funds to chase yield. And so the question is, when is capital, too much capital, going to potentially create an asset bubble? And I think that's what people are on the lookout as they look and see where transactions are headed in the market.
But from a source of capital, are you seeing over the last 2 or 3 years an increase coming through from Asia Pacific coming into your funds as opposed to US money?
Absolutely. I think our IR team spends probably the bulk of their time in the Middle East and Asia. And they're particularly interested in expanding into real estate, and specifically Europe and especially the UK, given the dynamics here.
Okay, and Coley, is that the same for KSL?
Similar dynamic, somewhat differentiated approach, but our current fund that we're still investing is a 2011 vintage fund, which was $2.1 billion of total capital. We're in the middle of raising our next fund, which is a little bit north of that. And I think to your point, John, we have seen a significant increase in demand from Asia Pacific. So I think over the last year, our efforts of spending time raising capital in other parts of the world has certainly paid dividends to us.
Okay, and in terms of where they want you to place that money, are they directing that they want it to go into more core economies and therefore playing into the hands of the UK, or are those decisions coming from you as the fund managers?
Well, we raise discretionary capital, so it is up to us. But they certainly, going into the fund, have a decent understanding where they expect us to deploy the capital. I think, and again, a consistent trend that you can see across other private equity and hedge funds is historically Europe was a single-digit percentage of our total capital deployed across. We're on our 10th real estate opportunity fund. And so historically, Europe represented a single-digit percentage of total capital deployed. In the last fund, it increased to 40%, again, on a fund that was 4 or 5 times bigger than historical funds. In our current fund, which is even bigger than that one, Europe may account for over half of all capital deployed. And so they are very, very keen for us to look for opportunities in Europe simply because that's where the distress is. I think when you talk about hospitality specifically, and where the UK is interesting, which has attracted so much capital, is where it's at in the cycle. The US, certainly the fundamentals are solid and improving, but the hotel market is in its 6th year of positive RevPAR growth. And yet we're here in the UK, and 24 months ago, we were all pleasantly surprised when suddenly 2013 turned into a positive RevPAR growth year. And so, as hot as the market is right now...
Is that a British thing? We were playing it down.
Perhaps. It certainly attracted a lot of Americans over here, unfortunately. But, so there's still a long way to go, we think, from a UK recovery standpoint, and our investors agree with us.
Okay, and Simon, you're there within a apart hotel and backed by private equity.
That's right.
What are your investors saying to you in terms of your expansion?
I guess as a beneficiary of that private equity, the enthusiasm they have to the hospitality sector knows no bounds at the moment, particularly acquisitive to develop the portfolio still further. I think that's evidenced by the recent acquisition of Seiko, from which Beyond has merged into, previously known as CL Service Departments, for those of you that are tracking what's been going on specifically within the apart hotel sector. I think there's very much a recognition of apart hotels as a distinct sector within the hospitality industry, as showing some sort of core property fundamentals. It's not as well developed as in other places around the world, which I think the US are very familiar with. So there's some real key drivers, and certainly as a recent recruit to the hospitality sector, having historically worked extensively in the student market, there are certain, I suppose, touch points that often I encounter groundhog days in conversations with banks and so on, in terms of trying to understand the specific dynamics of what the sector's all about, and that's very much what Oaktree, amongst others, have actually identified.
Okay, and Mike, I'm conscious you're there, and I've been talking about the private equity funds coming in. From a debt perspective, how the dynamics of the sector have been changing over the last 18 months for you?
Yes, if we go back to the beginning of the last recession, there were virtually no capital avenues available to anybody at all, to a stage now where it is hugely oversupplied to some extent. People asking for covenant-light deals and alternative funds coming from what would have traditionally been real estate funding. So at this current time, at the top end of the market, there are a huge number of alternative funding vehicles available. Capital seems to be flowing into the country, both through funds and through high net worth individuals. We're seeing lots of deals trading privately, from marinas to caravan parks to hotels, restaurant chains. So the whole leisure sector seems to be trading particularly well, and that is encouraging some of this capital investment. So very positive signs at this stage in the cycle, with people structuring accordingly.
And we've heard a bit about this morning about the various barriers to better performance. I wouldn't say they're restricting what the UK is doing, but they're a barrier to greater growth, whether it's the VAT, whether it's the visa issues. This is open to anyone on the panel, from a competitiveness point of view, do you look at the UK and see challenges for that as an investment environment? Anyone want to pick that up? Is it something that's a concern for you?
I think that if you think about, so my initial reaction to that question would be thinking about rate growth and the ability to drive premium rate throughout the UK through different hotels. And there's always been a difference of Southern England, Greater London versus the rest of the UK. I think that what we've found over the last couple of years is that if you have a superior product, you're delivering a very high level of service, you can drive premium rate, or at least a higher level of rate growth than had been experienced historically. in markets like Edinburgh, Glasgow, Aberdeen, Belfast, Liverpool, Manchester, et cetera. So I think that from a trend of kind of thinking about international capital coming into the UK, I think it's really, from my perspective, the biggest benefit to the UK is the fact that global hospitality and global real estate players now think of Edinburgh as a primary market. They think of Manchester and Liverpool as primary markets. It's no longer the kind of the other markets within the UK. They're all very strong on a standalone basis.
And I'd second that in terms of what we've been doing on the ground. Our initial focus initially, certainly sort of set up sort of just after the sort of upturn and the downturn, if there is such a thing, was very London focused, and combinations of just viability, competition, planning in London has made access to market extremely difficult. So we very quickly recognised the opportunity that was there in the broader UK. So acquiring assets in Aberdeen and Edinburgh and so on. Effectively, we've been shopping in the same places in that sense. So very much what's been going on the ground.
I think that's a key point, because across the UK, we still have quite a lot of variation in regional performance. So I was in Wales a couple of weeks ago for a tourism conference there, and they were claiming themselves to be quite a long way behind some of their European players in attracting overseas tourists in this case. And so when the banks are looking at sustainable income flows, they have to be looking at the market changes and even approach to, say, big data and attracting new customers. So we do see these threats from maybe lack of airport space, using Manchester versus Heathrow as an example, and could we get people into the country more efficiently, and when they land, do they know exactly where they're going? And it's working with the brands to actually understand their thinking around this big data and these economic variations around the UK. So that is potentially the UK's own limiting factor, just not understanding its own regional variation.
Yeah, I would agree. I think just having only been over here for about 3 years, our first observation was that a number of these UK markets were performing below their true potential. And you go outside of London and you're astonished by the destination appeal of many of these markets, and then you look at the rates that they're achieving in the markets, and then you look at the local tourism budgets or lack thereof, and the lack of levers that they have to sort of control their own destiny in terms of improving their convention facilities and creating, you know, specific marketing campaigns geared toward their destination. Because many of these cities that you're all so well aware of really have very limited brand awareness outside of the UK. And I think the UK is at a very important crossroads here, where you've got this influx of foreign capital that's coming in, and it's going to be investing significant money into upgrading the product quality, as well as an influx of foreign travelers. And so what's missing, I think, from that equation is empowering these local markets to really enhance their destination appeal, which, of course, touches on a number of complex political discussions, I imagine. But, you know, I think when you look at other countries, speaking specifically to VAT, other countries, you know, you'll have a sales tax component, a VAT component, but then you'll have a specific occupancy tax component that only the hotels charge, and that goes into a specific budget. And that's used to improve the zoo, the convention center, maybe even for grants for historic restoration, airports, all of these things that can drive tourism. Because, you know, as we all know, the beauty of tourism is it's highly labor intensive, so it creates an enormous amount of jobs, and it's all built basically using other people's money, because you're getting people to come to the market and spend their money. And so it's the best industry in the world for that reason. But you look at these markets in the UK, and I do think they're a bit handicapped in their ability to drive further growth. But I do think now is probably the best opportunity that's been around in decades to leverage that influx of foreign capital and visitors to really put some of these cities on the map.
And whose role is that? Is that local government, national government?
Don't ask the American, I don't know.
Mike, I'll ask you. You're firmly a Brit.
No, thanks very much. I do think there's a joint responsibility. So working with local tourism offices and actually understanding your patch in detail. When we go out and see customers, it's understanding the competition and it's understanding the dynamics of their market. And in its own way, that's a self-education. So working with people like the BHA, it is actually helping the guys on the ground, so SME level, right up to the big fast growth corporates as well. Quite often, the conversation we have is if they understand their customer and can market to them and get repeat customers at a cheaper acquisition cost, and get certain advocacy votes to encourage other people, it's a self-perpetuating circle. So the point being made is it's in everybody's interest to understand the science a little bit more deeply. So I don't think it's down to local government. I think everybody's got a role to play on that side.
Okay, and I hear a picture here that the UK is halfway through the cycle, third of the way through the cycle, whatever that might be. Cody, I know as an American you'd compare it to a baseball game and say you're on 4th innings out of 9 or whatever that might be. On that basis, Cody, why have you just sold out of Malmaison Hotel du Vin when there's so much more to come?
I would say just 6 months ago we bought a bigger business and made a bigger bet on regional UK with our purchase of Village Urban Resorts, which is 28 hotels across the UK, no exposure to London, a few around Greater London, but nothing within London itself. So our view is that the UK consumer has an exceptional amount of strength, and what we both, I think, collectively view, and a lot of other similar investors see that as untapped demand from a perspective of really driving further rate, further occupancy, and better experiences with better product and improved product throughout the country. Malmaison Hotel du Vin specifically was personally one of my favorite businesses in the UK, something that we acquired in March of 2013. The day that we bought the business, the headline in the London Times was triple-dip recession. So we bought it at a time where there was a great amount of uncertainty. Our view was, if you look at occupancy trends through the last 10 years, markets like Glasgow, York, et cetera, were exceptionally strong and exceptionally consistent, and we therefore felt that our thesis on the business would work regardless of what was happening from a macro perspective. Turns out the UK turned around a little bit in the summer of 2013. I think everybody's benefited from that. And then to your earlier point about additional interest in the UK and additional interest in UK hospitality, in 2013, to speak generically, it was an American fund seeing that opportunity, pouncing on it. We acquired the business in March of 2013. We sold it 2 weeks ago, well inside our typical hold period, but what happened was we received a number of unsolicited offers and inquiries into the business towards the end of last year, and we ended up selling it 2 weeks ago to a Singapore-based business where they saw that opportunity to invest heavily in the UK outside of London.
Okay, so it's a great vote of confidence in the market. But you're still in the market for more investments in the UK?
Absolutely.
Okay, because you're getting the sense from certain parties, you trying to look at where your exit is down the line, and you talked a little bit, Cody, about the pressure on pricing now, driving that forward. Is that something that not so much undermines your confidence in the UK, because I think we all accept it's a very strong market going forward, but makes you more ready to look at other territories to expand into Europe?
Well, I think if you look at the world from our view, from investment perspective, being a series of real estate funds, we have to wear multiple hats on a daily basis. And so, I have hotels that we've owned since 2005 that sit in funds that are 4 funds ago. And I have a very different view on the world with those assets. It's very much about liquidation. We have funds that we raised right at a sweet spot, sort of 2012, 2013, where to Coley's point, we may look at a shorter hold period than we normally would just because the market has moved so quickly during that time period. We're now onto our new fund. And so if you look at us and you think that we're one of the bigger hotel owners in the UK, well, actually I'm sitting on this major fund, and we've only done 2 hotel deals in the UK. And so I own almost nothing in the UK hotel space. And so there's a strong desire to make some significant bets in the UK hotel sector. The challenge has been is the fundamentals are so strong here. There's so much liquidity. It's such a great place to do business, good people, good rules, everything, that people just, capital it flows like water. It takes the most efficient path, and UK is by far the most efficient place in Europe to do business, particularly in a hotel real estate where it's got an operating and a real estate component to it. And so that's that. At the same time, these funds have changed the structure of their funds because interest rates have gone down. And so investor return requirements have gone down. So the cost of capital in these funds has decreased over the series of funds. And so it's driven down prices, driven up prices, driven down cap rates, and made it a lot more competitive to win in the UK. And so, yeah, it's forcing people to look to the continent. The challenge with the continent is, in many cases, it's the polar opposite of what you find in the UK. There is no liquidity. There is no motivation by the domestic banks to delever their historic legacy assets, and except some cases. Spain has been a nice place. We've been successful in doing some deals there. And then you've got the whole situation of labor, because obviously we run an operating business, and you've got to look at the labor regulations in each of these countries when you determine your investment strategy. So I think we're going to continue to look to make big bets in the UK, even if it's going to be more expensive than we'd like, and certainly a very different place than it was 24 months ago.
Okay, I mean, it's probably a good time to touch upon the EU referendum and what an exit vote would, the impact it would have for you. Any comments, Coley or Simon, from your perspective?
I think the general House view would status quo remain would be good. I think
we heard Andrew say that, and
we went long on Scotland, having sort of, I suppose, backed a view that there would be a positive vote in staying together on the back of that. So I suppose we've already demonstrated the strength in that. I think there has been a significant bounce in confidence in the Scottish market as a result. And I think you can see similarities, obviously, between those two votes. So,
is that going to impact decision making as you get closer to the event, do you think?
It'll impact capital markets, and so I think that'll absolutely impact kind of how we look at valuation, how we look at capitalizing businesses and new investments. Ultimately, I don't think it's going to impact consumer behavior in the long term, and that's what's attractive about the UK to us. I don't think that domestic tourism, domestic travel, either corporate travel or domestic or tourism, leisure travel, will really be impacted meaningfully by that decision.
Okay, so in some ways, given you said when you bought Malmaison Hotel du Vin, it was with your triple dip recession on the cards, a bit of uncertainty like that gives you an extra opportunity to back your long-term views about the market and come in and maybe at slightly better value.
As long as we have a strong enough investment thesis in a business where we think we can add value regardless of what's happening on kind of the macro scene, absolutely.
Mike, I'm going to come and talk to you a bit about the debt markets and how it's playing in, but I just wondered if there's any questions from the floor at this stage rather than leaving it to the end. So the lady there, if we can get a mic.
I was wondering, are you more interested in investing in a sort of standard hospitality models or the more innovative concepts such as, for example, Hoxton hotels or One Fine Stay? What's more interesting business-wise and future-proof-wise, basically?
Who wants to?
I'll take it first. From our perspective, our mandate is to invest in travel and leisure businesses, whether that's something that's tried and true and old, traditional, or something that's a little more forward-thinking, more progressive. It doesn't matter. As long as we see growth opportunity and we see real demand from a consumer, it's absolutely something we'd consider. Our challenge on the One Fine Stays or the business that Wyndham just invested in here in the UK is that's not really kind of our style of investing. That stage of a company's growth, it's not really appropriate for our fund. Our fund, we typically look to businesses that have growth profiles or have an existing source of business that is strong enough to warrant a substantial equity investment. But absolutely, those guys are on our radar. Absolutely, personally and professionally, I think they're great concepts. We're trying to figure out how best to be involved with them. A direct investment today is probably not the right path.
Yeah, and I think in terms of new brands and developing new areas, such as Whitechapel or other parts of London, there is a huge interest at the moment to look at new concepts, and we see this in the restaurant trade in particular. So there are a number of fast rollout businesses where owners are getting together with investors, and this is at the kind of high-end SME level, where there is fast growth coming through quite quickly as consumers are more confident to spend on leisure, be that eating or traveling or hotel spend. So we, in the banking community, are seeing quite a lot of new opportunities coming through with new ideas and new concepts, which is what's keeping everything quite fresh, actually. And the propensity to spend is going up all the time, according to our own customers' management accounts.
But Mike, I mean, banks are supposedly conservative, certainly on the senior debt. How do you sort of really assess and evaluate those new brands coming through and get confidence that they're going to succeed?
Yeah, in most cases, we don't take equity risk. That's not our role. But we do spend a lot of time with management, and management is the key to a successful business plan, to the extent that 35% of that business plan will be based on management ability. So location is one thing, management ability is another. Operational solutions are as important as the debt provision. So if you can make your business as efficient and profitable as possible, then that's another coordinate that we'd look to pull.
And I think I could support Mike's view on that. Talking to some of his competitors on the ground, that's very much what we encountered. So as a new co, with the fortunate benefit of having some equity behind us, who recognised a subsector of the hospitality market to play within. Very much it was a view on how that operational base and the delivery and performance of those assets. That's very much what drove the acquisition of the Seiko business.
Okay, any other questions from the floor? No, in which case I will carry on. Mike, we touched briefly upon some of the new entrants into the debt market, so I'm just interested in how you've seen them sort of impact your business on the banking side. Perhaps just explain who's come in, what that means on pricing, how the structure of the capital stack is now.
Yeah, so I think in terms of the non-bank lenders, typically real estate funds have come in. They've set a price which has been significantly lower over recent years than it was a few years ago. We have seen situations where they've been quite happy to work in partnership, a tranche of funding going off to a non-bank lender, another tranche staying with the bank or the banks, and one is locked away for 10 years. The other one is a more dynamic lending platform, which might be operational funding, as well as maintenance capex or a package available for expansion. So a dynamic now is where banks will work together with financial sponsors or non-bank lenders, and pretty much as long as you can get the structuring right, then we can work together, and it gives the customer, the end user, much more choice in terms of their options.
Okay, and typically how far up is the senior debt now? If you're buying something for 100, how much senior debt would you typically put into let's say it's a freehold hotel in a decent regional town?
So if we're looking at leverage, then typically we, Barclays, would look at sort of 6 times leverage, I guess. Loan to value, that might
6 times EBITDA.
EBITDA, sorry, yeah. Which might translate to 65, we might even get to 70% loan to value. But we prefer to look at the cash flow metrics because that's the ability to repay, and we'd always want an element of repayment in there because that's the nature of how we work our balance sheet.
Okay. And guys, those of you who are borrowing the money, is this what you're seeing? Is there more attractive deals out there with new lenders?
I think the UK is a great place to be a borrower in the hotel sector today, and that was not the case 2.5, 3 years ago. And I think some of the early deals, Malmaison, our principal Haley, really opened up the gates to provincial hotel lending in the UK again post-recession. And the UK domestic banks have certainly gotten much more active, especially as they've carved off the bad assets into sort of internal bad banks in some cases. And you have had a flood of alternative debt funds. We're one of them. We have 2 publicly listed debt vehicles that we lend to in the real estate space. And then you have some limited number of U.S. banks, balance sheet lenders coming over here like a Wells Fargo. But what I think is great about borrowing in the UK is it's largely relationship driven, which is so refreshing. It's almost a foreign concept to me because in the U.S. it's dominated by the CMBS markets, and so there's an originator who then syndicates off the debt, and then you're dealing with a servicer administrator going forward. Whereas here,
Which is great if it goes well.
yeah, great if it goes well until you need something, right? Over here, you know, I'm sure half my lenders are in the room right now. I mean, this is, you know, personal relationships, and it's great to be a phone call away to give them updates on the business, to meet when they're, you know, discuss any sort of updates to the business plan. But it certainly, you've seen spreads come way down, and so you do, you know, frankly, sort of have your pick of the litter, so to speak, right now from a borrower standpoint. But a lot of the deals being done are larger deals, and so these are deals that are going to require some sort of syndicate. So in our largest UK hotel platform, we have 6 different lenders in our syndicate, and it's all the big banks on the domestic level. So it's always important to sort of balance those relationships, because you're going to run into them every other week out in the transaction market.
Okay.
I think as we're trying to develop our own portfolio, one thing I would say is development still remains a dirty word in the funding market from our experience, particularly without that demonstrable track record. Having said that, I've seen a distinct turn in appetite over the last 6 to 9 months in particular, improvement in pricing, improvement in appetite. Even heard targets mentioned again, which is nice to hear. And I think the other thing we've sort of picked up upon in terms of the sort of new sector is also the institutional appetite and creating income strips from the income that is created from the hospitality business, and whether that's actually done as a sort of ground rent and then senior debt tiers thereafter, either with a more mainstream lender or actually internally. There certainly seems to be quite a lot of appetite for that, and I think a growing sector of the debt markets, if you want to call it a debt exit, really. So.
Okay, and Mike, are you comfortable with the concept of carving out the ground rent, allowing the operators to sell on at a low yield to an institutional investor?
Yeah, I think we look at different structures all the time. So the CMBS market was pretty big in the UK a few years ago. We're looking at a lot of different new structures now. So we will have individual conversations. We won't judge anything as a sector. We'll look at individual situations, and some models are right and others not.
Okay, and perhaps it may be useful, given the breadth of the people in the room here today. It's all well and good, a Starwood or a KSL talking about their business plan and be very sophisticated. When you're lending down with some of the independents, Mike, you know, what are you expecting from a bank's perspective in terms of what they have to produce to you to get that investment, get the loan?
Yeah, look, it's pretty straightforward. Every business person knows their business better than anybody else, and really it's their story and how they articulate their story to us. So it's not a sophisticated financial model, but it is at SME level, it is a basic understanding of what they want to achieve by when and how, and it really is a two-way partnership. The point about being able to pick up the phone and talk through the situation, the trading that month, the seasonality. Look, we're predicting a pretty strong outlook, so it's how businesses are going to capitalise on that. And as I said earlier, most businesses that are making their own projections, they do believe in their own projections, they created them, and actually in most cases, 9.5 out of 10 probably, they're achieving their own ambition.
Okay, and are they using the digital world around them to help deliver that product? Are you seeing that coming through, both in terms of how they present stuff to you and how they're then communicating with their customers?
Yeah, hugely. I don't necessarily like the big data type expression, but this digital transformation and how people do business, and whether there is space for other solutions in terms of Airbnb and other models are in the market. We know that it's here and it's helping, and actually a lot more of our customers know their customers better than they did 5 years ago. So this big data concept is really quite positive, and it's dynamic marketing. So we're seeing a lot more of that. And we obviously have changes in the demographics where people need to know that with 5 generations in the workplace, you talk to each of them differently and they want a different level of service. So that's what I mean about understanding your customer base.
Okay, we've got about 5 minutes left, so I don't know if there's any more questions from the floor. We can go on, but don't want to stop me. No, in which case we'll carry on. Talking about sort of moving forward then, it'd be quite good just as the wrap up to talk a bit about what's coming next, where you see the markets but then also to what degree sustainability is programmed into your investments going forward. Because whether it's here now, in 5-10 years' time, it's certainly going to be more important, I think. So to what degree do you reflect that in your investment decisions? Who wants to?
I think thinking about, I think, two earlier comments. One, your point about development, and my friend in the second row here, her question about how you're more progressive with your business models. I think it all kind of ties into, as you take an existing concept and continue to build it out forward, and we see a lot of demand throughout various parts of the UK and various sub-markets in the UK that could actually go for a significant amount of supply increases. So as we take some of our existing concepts and try to think about how best to develop those out and build new units, new stores, I think you do have to think about sustainability. You do need to think about modern and progressive ways of operating a business, and that all feeds into basic kind of building efficiency. So what do you do with front desks? What do you do with the check-in experience? What do you do with the use of space in a hotel room? And is the movement really toward a much smaller hotel room and a more active common area? Probably. And how do you do that from a development perspective? And then how do you get a lender to buy into it? It likely means that you're going to do a few of those deals, all equity, on balance sheet within an existing portfolio company to prove out the concept, and then you can go get third-party capital, either debt or equity financing. But that's how we kind of think about it in terms of what does it mean for the next level, the next generation of hospitality product.
Yeah, I think going back to my point earlier about the opportunity that the UK hotel sector has in front of it. There was a first wave of transactions which, to the average investor, it wasn't even on their radar because these were major non-performing loan pools, distressed debt deals with hedge funds. The more high-profile platform plays that you saw, groups like KSL and Starwood Capital make, were more sort of direct corporate deals. But there were billions of loans that were acquired by Cerberus and Lone Star especially, Sancati. And these are hedge funds that are not long-term real estate owners. And so you can expect to see a huge wave of dispositions in the coming 24 months. It's all coming at once. And within that are large portfolios of assets that have been fairly capital starved, remembering that the recession, hit, 2008. And so some of these properties have not had capital in 10 years, really. And so a lot of the sustainability actually can come, and we're finding in our own hotels, we're investing, a couple £100 million right now in our UK hotel platform. And a lot of that is, pure coincidence, which is great, is strong ROI through energy improvement. And so I think you'll see that the UK, particularly in the provinces, I think has had sort of a reputation of being tired product, kind of years in the past from an innovation standpoint. And so I think when you talk about innovation and sustainability and rates and product quality and destination appeal, it's all tied together in terms of capital. And the capital's coming into these markets. And the first wave, really was more of a hedge fund distressed debt game. So they did fix some things, but they certainly didn't fix everything. And so I think when you see the next owners coming online to buy these portfolios and platforms, it'll be much more of a capital investment story in terms of investing in product upgrades, which is going to touch on all of the points we've talked about today.
Who's going to buy that product? Because it said that private equity don't like buying from private equity,
Yeah.
although we see that happen.
Yeah, no, that's a very good, I think the Malmaison was a good example. I think private equity, and we've been saying this for the past year, that there's only one way that this ends, which is that private equity is going to have to buy from private equity. So, we've been bidding on things, this month, all last month, and I think everything that we've been bidding on is from hedge funds and private equity groups, and Blackstone was selling Center Parcs, and we looked at that. And it's just, again, these are legacy funds selling to new funds in a new environment. You got to get past the fact that you're buying from your competitor if the deal works on its own. And so I think you will continue to see private equity groups active. I do think, though, where it's going to change is you will see a bit more of the Asian capital coming in, because they weren't that active in the last few years. But also, more importantly, I think it's going to open up more opportunities for the domestic buyers. And we're out in the market with several deals, including a large portfolio right now. And you see the profile of the buyer shift from being more of the mega private equity fund to more of the mid-market UK domestic private equity fund. That I think there's a lot of opportunities that will be had in terms of buying these assets that were originally acquired by a hedge fund in a loan pool. They didn't spend any money on it. They rode the market up for 24 months. They're going to flip out of it, make a huge profit, but you can still own this hotel at a very attractive basis with huge upside through proper investment in CapEx and systems and resources. So I think that the trend in the next few years will be more opportunities for the domestic buyers.
Look, I think it's a trend as well. We're seeing smaller businesses, lots of merger and acquisition opportunities. So the small businesses are being acquired. They're quite happy to sell. It's a nice marriage with some cash out for owners looking to retire or to expand their business. That business becomes a mid-sized business, and then it becomes available on these guys' radar. So it is a self-perpetuating cycle, really. And we are seeing a lot of M&A activity, people looking to buy and sell at the lower SME level, which is going to help fuel the bigger deals later on as well with this kind of concept development.
I think that's a perfect place to stop. There's clearly opportunity right across the market, from the big boys to the smaller investors, and there's always the individuals, the entrepreneurs who are going to take forward the businesses. So I'd just like to thank the panel this morning. Thanks, guys.